Hi everyone, and welcome to another ITPM Flash. Let's get straight into things. So as many of you will be aware, so far this year we've had a very large dispersion in performance between the Magnificent Seven and most of the rest of the stock market. The Magnificent Seven being Meta, Amazon, Apple, Microsoft, Alphabet, Tesla and Nvidia. The outperformance has been such that as of August 23rd, those 7 firms in total had generated a 58% aggregate return compared to 4% for the remaining 493 components of the S&P 500. I thought that also one thing of interest as well with respect to this outperformance is that the NASDAQ outperformance has occurred despite a $3 trillion reduction of balance sheet assets between the Fed, the ECB and the Bank of Japan since early 2022. And in fact, that kind of breaks what was previously a tight correlation between central bank liquidity and the share prices of fast-growing, highly valued tech stocks since the end of the global financial crisis. And also of interest, during last week, Michael Hartnett, who is Global Head Strategist for the Bank of America, commented in a report that their team put out, "We say that tech equals second half trouble rather than an era of new AI rules." And tech isn't just outperforming the rest of the S&P. In fact, global stocks have also massively underperformed US tech. So year to date, US stocks have outperformed global equities by almost 3 times. To put that into context, even during the 2001 dot-com bubble, US stocks peaked at about 1.5 times outperformance. And in fact, since the early 1950s, US stocks outperformance compared to global equities has not come close to 2 times, let alone the 3 times that where we presently sit. Here's a chart from Bank of America's Global Investment Strategy team. And what it shows you is the degree of outperformance of US equities versus global equities in US dollar terms since 1950. As you can see, we've had some fairly large cyclical moves there over long periods of time. But as you can also see, this most recent outperformance, which actually began at the end of the GFC, is something the likes of which we have never seen. Here, I'm also displaying a chart of the VIX over the last 12 months. As you can see, we got a pop up in the first half of August, but that has come right back down again. So where we sit now, which has obviously coincided with the equity market rally off its lows during the early part of the month, we've now got what looks like a fairly relaxed volatility environment. So where do we find ourselves at the end of August 2023? Well, I think it's worth having a quick recap of how we got to where we are. So if you remember, 2020, 2021, governments around the world were printing a massive amount of real economy money. We also got globally concerted inflationary money printing from the central banks. So basically, we got deficits and credit creation, the size of which we hadn't experienced since the end of the Second World War. Subsequently, of course, we got production and global supply chains being closed. And then subsequent to that, of course, we had economies reopening extremely rapidly. Now, what did that do? It meant that the first the initial release valve was a dramatic acceleration in earnings and asset prices during 2021. And then with the usual sort of 18 months to 24 months of macroeconomic lags, we got the second release valve in 2022, which, as we all know, was inflation. What happened then? Central banks quickly reversed course and tightened aggressively over the last 12 to 15 months. Of course, then what happened was year-on-year EPS growth went negative and credit creation slowed down extremely fast. So by the end of 2022, most people were expecting a recession. We didn't get one. So does that mean that we're completely out of the woods? I'm not sure about that. One thing we can say, though, is that certainly the macro lags on the tightening side of the equation are taking longer than almost all of us expected to materialize. The US is still printing money via large fiscal deficits, and the private sector has locked in cheap funding for longer, which has therefore delayed refinancing at higher rates. Now we've got a real growth rate around 1%. We've got core sticky inflation coming down into the sort of 3% annualized area. And so where do we sit now is consensus has moved to the idea that the US will have a soft landing and that rates will be higher for longer, and that possibly we've got one, maybe even two rate rises to come before this rate rise cycle is done. So what happened in the first part of August was that US government yields were going higher. Eventually, equity markets got the memo, and of course they sold off. But since then, we've actually seen a rebound, so that actually end of August, we've got the S&P basically flat, and the VIX back to just above 14, as shown in that chart earlier. So in other words, if we looked at things from the end of July to the end of August, it would appear that overall, during the kind of peak summer lull, nothing much has really happened. The big swinging dicks will be returning to their desks after the Labor Day holiday weekend next Tuesday. And I think that September, October is when we're going to see some real action. So for me, it's probably a good time at the very least to be picking up some cheap, on an implied volatility basis, portfolio insurance. I think it's natural that we need to now start thinking about where equity and bond markets will be going for the last part of Q3 and of course during Q4. Consensus may well believe that a soft landing is the most likely outcome. I am not so sure that we're out of the woods regarding something being broken, because there's precedent for that. The central banks almost always over-tighten and also over-ease. So don't forget, we have seen what has been a very historically rapid rise in rates. So where I sit now is I'm definitely not chasing 2023 FOMO trades, especially in tech. I'm looking much more defensively, scaling into outright underweight stroke short equities. Now, as we mentioned earlier, most recently in the second half of the month, equity markets have rallied off their lows due to weaker labour market data. We've got non-farm payrolls out this Friday. Now, what happens, I think it's a good question to ask, what happens if we start to see sequentially weaker job market stroke economic data going forward for the rest of the year? And so if that means that yields stay at elevated levels whilst the economic data deteriorates, that eventually is going to become pretty unsupportive for equity markets. As I said earlier, the VIX is still not showing any signs of distress. If you look at both the absolute level of the VIX and the VIX curve, there's basically no signs of nervousness in the stock market. I believe that the NASDAQ trade, the Magnificent Seven trade, is a crowded long. And I also think that if interest rate policy stays tight in the face of weaker macroeconomic data, that will eventually be quite a difficult environment for small mid caps, which are US economy centric. In other words, that would be tough times for Russell 2000 stocks. And of course, we've got an ETF, a very liquid ETF, whose ticker is IWM, that we can trade with respect to the Russell 2000, and there are also options on the IWM. So just to be clear, I'm not getting overwhelmingly bearish at this point, and of course I've still got a long short portfolio on, so of course I'm not overly extended on any one side of the ledger, as it were. I've still got a long short portfolio on, but it's at the moment with a short bias, and I've got some put strategies that will yield great reward to risk if we actually do get a decent equity market sell-off during the autumn. And last, and I won't say least, but I hate to mention the barbarous relic, but I do actually think that gold might actually be worth a look coming into the end of Q3, going into Q4. with respect to what I've been saying. So thank you very much for watching me, and see you next time.